Good afternoon, everyone, and welcome to Unicapital's 2026 Mid-Year Market Outlook, The Road Ahead. I'm Twinkle, and I'll be your host for today's session. As we enter the second half of the year, investors continue to navigate shifting market conditions, global developments, and changes in the local economic landscape. Today, the Unicapital research team will help us make sense of these developments and share their outlook for the Philippine economy and stock market, including the key sectors, opportunities, and stock picks to watch in the months ahead. We hope today's session will give you the greater clarity and confidence as you plan your next investment moves. If you have any questions, feel free to send them through the Q&A box or type them in the chat box. Our speakers will address as many as they can during the live Q&A session later. And now, let's begin. It is my pleasure to introduce the Unicapital research team, led by Head of Research, Wendy Estacio Cruz, and together with her, our research analysts, Peter Garnace, Jer Alfonso, and Lance Guy. Please join me in welcoming the team. Good afternoon.
Good afternoon. Good afternoon, Twinkle. Thanks for the introduction and good afternoon, everyone. I hope you're safe, whether you're at home or you're in your offices. I hope everyone's safe and thank you for joining us this afternoon, despite the weather. And I hope you'll gain a lot of insights from us as well. So I'll just share my slide. All right. So I think right now the question of majority of the investors is the market pricing in too much bad news? Because if you look at the index PE, we're at almost 40% discount compared to the historical average. And that's actually one of the largest or the significant discount um among the Southeast Asia. And I think the reason for this is because the market is pricing in three major headwinds. Number one is the geopolitical risk, which is actually uncontrollable. We cannot or our government cannot really have any control on how oil prices can uh be tamed, to keep to keep inflation contained. So then the next thing that we see is the domestic political uncertainty. So right now there are a lot of political noise that we hear every day. Also on the infrastructure spending, the fiscal budget. So that's still keeping our economic growth subdued. And lastly is the El Nino. This episode will have some impact on inflation. So this could keep inflation elevated for the rest of the year. But later on, I'll tackle our outlook on the inflation rate. And then lastly is the our index outlook, which we slightly lowered to 6,650 from 6,800 target at the start of the year. All right. So the first thing that I mentioned is on the domestic political uncertainty, which I believe poses a near-term overhang for the Philippines. As you can see here at the left-hand side chart, infrastructure spending is still below the historical average as a percentage of GDP. By the end of 2025, we're at 4.7%, and that is lower compared to the historical average of around 5 to 5.5%. And this year, we're still expecting it to remain at sub 5%, at 4.3%, before starting to normalize and improve in 2027 and 2028. So the main reason for this is because a lot of budget monitoring is still in place. So there's a continued monitoring of the projects, as well as the execution and the disbursement of budget to execute some of the projects. And that resulted into slower GDP growth, which is at 2.8% in the first quarter of the year. And we're looking to see a GDP growth rate remaining below 5% for the full year of 2026. Also, unemployment rate. I think just this morning they released the June 2026 unemployment rate, which is at 4.9%, which is above the 4.8% record last month or in the previous month and compared to last year. And we think that this will continue, and this is likely to continue given that um, number one is the slower infrastructure execution, and number two is on the wage hike. So because of the wage hike, there's a possibility that a lot of corporate or companies will have to defer their hiring because of higher cost. So aside from the wage hike, the third cost that we see is on the oil prices, fuel and oil prices. So there are a lot of factors that really is pushing pressure or putting pressure on the cost side. That's why we're thinking that unemployment rate could stay elevated in the near term. And I think one risk that is worth highlighting is our credit rating. Right now, although we see stable outlook from the rating agencies for the Philippines, Moody's, S&P, and Fitch, we think that subdued or slower, further slowdown in the GDP growth may result into credit rating downgrade by any of these agencies. And if that happens, that's actually gonna put some risk premium over the market. The second um, risk that I highlighted is the geopolitical risk. And as a net oil importer, Philippines remains sensitive to sustained oil price shocks. We all know that oil price has reached or breached the $100 a barrel level, and we still expect it to continue going up over the next couple of months, given that there's still no the de-escalation of the tensions. And as you can see here in the right-hand chart, as of the full year of 2025, the Philippines remains one of the most dependent net oil importer across the some of the countries that are stated here. So, in our view, because of the higher oil prices, we think that that should put some pressure still on inflation rate. We are expecting inflation to spike to 6.1% for the full year of 2026. And another layer of pressure is coming from the domestic side, which is the El Nino episode, which is expected to be in the fourth quarter of the year. And just to give you some um, perspective on how the previous or the past episodes affected the inflation rate. So, for example, the 1997 episode, that's one of the most severe El Nino events on record, which put or added 3.6 percentage points on the inflation rate. Inflation rate at that time peaked to 9.4%. And that's because of the impact on the rice, corn, vegetables, and other um, livestock products. And Just to note that over the past episodes, we saw some at least zero point 0.5 to 1.5 percentage points increase in inflation rate uh, compared to what it was before. But this year, we are expecting a different theme because, as you can see, we are actually expecting the inflation rate to somehow moderate from this year. So next year we're expecting it to moderate to 4%, 4.1% coming from 6.2% this year. And the reason for this is because I think the difference now is that um aside from the supply side inflation, there will be some normalization in terms of the higher oil prices. Since we're expecting the escalation of tension over the next 6 to 12 months, we think that oil prices will somehow normalize as well. So that should help inflation rate to go back to 4% levels. So basically, we're expecting it to go down because of a high base impact in 2026. And we think, as for the sectors, we think that there are still some sectors that are likely to outperform these headwinds, such as the banks, utilities and power, telco, as well as consumer staples. And for the sectors that may face some challenges, I think consumer discretionary is one, mainly because of the margin pressure, and then property sector, given higher rates and um, uh, also the lesser demand for residential, and lastly is the water utilities. For our peso outlook, we think that it could range from 59 to 61 for the year. And we think that the BSP will continue to monitor and cushion the impact on the peso um, going forward. So as you can see here in this table, for the past 5 years since 2021, the PE of PSEI has been declining over the past 5 years. But year to date, we saw that the PE is actually stable or steady at 9.5 to 9.8 times, which is flat year on year. So we think that it could be the finally the end of the derating for the PSE. And just to give you a recap, our PSEI was flat during the first half of the year compared to, for example, in the ASEAN 5, Thailand, Singapore, and the US markets outperformed us. And that is, I think, mainly because of some cushioning effect on these countries. So, for example, for Singapore and Thailand, there are a lot of or a majority of their equities market is actually exposed to sectors such as AI, tech, semiconductors, as opposed to the PSEI. So we don't have a lot of companies here that's focused on these types of sectors. That's why we don't have an offsetting factor when it comes to the risk on uh, us being a net oil importer. Now, for our outlook, I think this is what majority of the investors are asking. And for the rest of the year, we're looking to reach 6,650, and that is based on a re-rating from current 9.5 to 10.5 times, and corporate earnings growth of around 7%. And even with that levels, PSEI would still trade almost two standard deviation lower than the historical average. So as shown here, if you will compare where we are compared to the rest of the pack, we're actually one of the cheapest, at 40% discount to the historical average, next to JCI and Kospi. And I think the most of the headwinds that I mentioned earlier is already priced in, given that a 40% discount is looks excessive at this point. So that's for our index outlook. Now um I'll go over our sector views. First, on the banking sector, given the change in the BSP's direct policy direction, um, from easing to tightening, we are expecting banks to actually outperform the rest of the sectors, given that uh, they will be able to support names going forward, especially the asset yields. Um, Right now, we're expecting banks to deliver around 10 to 11% loan growth. Although this is much slower compared to the past 2 years, that should be offset by better NIMs going forward. Actually, at the start of the year, we were expecting NIMs to decline by 20 basis points, but because of the change in the policy direction, we expect NIMs to actually be flat to slightly higher. Beyond core lending, the fee waiver impact on InstaPay and PesoNet will modestly reduce fee income, with an estimated impact of 3 to 5% of fee income, and just 1 to 2% of the total revenue. So I think at these levels, the impact would be negligible. Although that should still result into near-term weakness, but it should be offset by higher digital adoption going forward. So net-net, it will lead to lower cost to serve for the banks. And on the asset quality, it's actually showing some signs of normalization. For me, it's still benign, given that NPL ratios of banks are actually improving. It's just that they have to be more conservative given the current macroeconomic condition. So they're actually providing more for the rest of the year, um, given that the expected credit losses is becoming higher compared to what they initially expected. So with that, we're expecting banks overall to deliver flattish earnings this year before improving to high single digit growth by next year. In the sector, we have buy ratings on most of the banks, and our stock pick is Metro Bank. Now, for the Philippine REIT sector, I think the appeal, or it's not that attractive at this point, given that the yield spread is actually negative. If you will compare here in figure 2, if you will compare um the REIT companies dividend yield as opposed to the 10-year BBL rate, it's actually negative, negative 30 to 50 basis points. And as a result, I think investors are staying away from REITs for now, but they are monitoring the portfolio quality of some of the names. For example, um, RCR, AREIT, and even MREIT is now adding more retail hotels and other like industrial. They're looking to add industrial also in the portfolio mix in order to reduce the office concentration risk. So in figure one, as you can see here, retail is actually improving when it comes to the um, total portfolio of the companies. As for the property sector, I think the tighter monetary policy will continue to weigh on residential sector. Developers remain cautious, hence fewer project launches for these names. And if you look at the inventory, inventory is still elevated. So they might still focus on the existing inventory before launching new projects. But I think what's interesting is that there's still support when it comes to the demand, but it's coming from the provincial markets. As you can see here, provincial home prices is still rising by 6% compared to those in NCR. So I think that's the trend, which I believe started even prior to the pandemic. But uh it's becoming more apparent at these levels. That's why majority of the developers are focusing on launching projects outside of Metro Manila. So for the sector, we favor those developers with strong recurring income, and at this levels, property stocks are actually still at a discount. So I think uh most or majority of the risk or the concerns is already being priced in. It's just that it's a matter of time for these names to start gaining momentum again. Now for the power sector, I'll now pass it to Peter, our power analyst and telco analyst and others. Go ahead, Peter. Thank you.
Hi everyone. Good afternoon. So now for the power sector. So while we are cognizant on the regulatory overhang clouding the sector, we are taking a constructive stance on the power sector as we see three forces reshaping the sector moving forward. First, global oil supply risks are reminding us why energy security matters. As fuel prices become more volatile, companies with diversified and reliable power generation are in a better position to benefit, especially that we need more indigenous and renewable energy capacity in the Philippines. Second is the return of El Nino, which we believe could tighten electricity supply. And historically, this has pushed power prices higher, which benefits generators with exposure to the spot market. And as you can see in the figure one on the upper right side, OSM prices have already been trending higher this year. And this would really suggest or explain why our Meralco bills have been trending higher as well. So thirdly is the US led Pax Silica initiative, which we believe could drive a new wave of electricity demand from AI, data centers, and semiconductor manufacturing. So these industries consume large amounts of power. So these technologies are power hungry, and this could create a structural growth opportunity for the sector in the coming years. And of course, we are also cognizant, we're conscious about the recent regulatory overhang on the sector, which includes the proposed amendments on the EPIRA law and also especially the removal of system losses. And additionally, is the delay in Meralco rate reset or the rate reset on its distribution utility rate, which we believe would continue to weigh on investor sentiment in the near term. But we believe these are more sentiment driven than a reflection of its solid fundamentals. Our top pick for the sector is Aboitiz Power with a target price of 55 peso per share. We do like AP because it has a diversified generation portfolio across coal, hydro, geothermal, solar, and natural gas, giving it resilience in different market conditions. And just recently, also, the DOE has released that Aboitiz Power is the top or the largest generation company in the Philippines, accounting for roughly around around 25% of the national grid. And we believe that in the sector, scale matters. And it also has balanced exposure to the spot market, allowing it to benefit from higher power prices while still providing investors with attractive dividend yield of around 5%. Overall, we believe AP offers the best combination of defensive stability and long-term growth as the Philippine power sector enters a new investment and regulatory or policy cycle. Now, moving on to our next sector, the Philippine or the water sector. So, despite concerns on the return of El Nino, we remain positive on water sector as we believe the industry is much better prepared today than it was during previous drought episodes. As shown in figure 1 on the upper right, Angat Dam recently fell to a record low level. That's around 150 meter in terms of water level, raising concerns about Metro Manila's water supply. And this has also weighed on water utility stocks like Manila Water and Maynilad in the past few weeks. But the key difference today is that the sector has evolved compared to the previous El Nino episodes. After the 2019 water crisis, both Manila Water and Maynilad have invested heavily in alternative water sources and expanded their treatment capacity, which essentially reduced their dependency on Angat Dam. And that means that now both companies are more resilient than ever if El Nino becomes more severe as forecasted by uh, Pag-asa. Another important point is that water demand remains highly defensive. So in the past El Nino episodes, we have observed that domestic and commercial demand continue to remain resilient even during droughts. In fact, during the 2010 or the more recent 2019 severe El Nino episode, both companies still delivered a solid revenue growth despite water shortages. And as shown in figure 2, build water volume have actually continued to trend higher over time. Under the sector, our preferred stock is Manila Water with a target price of 50 peso per share compared to Maynilad. Manila Water trades at a more attractive valuation while offering higher profitability and dividend yield of over 6%. And this is supported by a more diversified water portfolio. Overall, while El Nino may create short-term concerns, we believe it doesn't change the long-term investment case for the water sector. And the sector remains defensive, resilient, and our top pick, Manila Water, offers the best risk-reward opportunity. And moving on to the next sector, telco sector. So for the sector, we remain guarded but optimistic because while sentiment has been weak, at least in the first half of this year, the fundamentals have remained solid in our view. The market has been concerned about inflation and competition, but demand for mobile data and broadband continues to grow. As shown in the charts, both mobile and broadband subscribers remain on an upward trend, providing a more stable source of earnings for the sector. And looking ahead, we expect the second half of this year to be an inflection point for the sector with broadband growth recovering as operational issues normalize, while mobile remains the sector's earning anchor, supported by higher 5G adoption and improving data monetization. Another exciting catalyst is the value unlocking initiatives being done by Globe and PLDT. So the Globe plans to list Mint, which is the company behind Gcash, while PLDT plans to launch or to IPO VitroRit, which holds its data center assets. So we believe that these initiatives could help investor recognize uh, um, uh, or crystallize the value of their fast-growing digital businesses beyond their traditional telecom operations. Our top pick is Globe with a target price of 2,400, and we like Globe for its attractive dividends and potential upside from the Mint IPO. Also, we have a buy call on PLDT backed by strong cash flows, industry-leading dividends, and also the catalyst driven by the IPO of Vitro REIT. We believe the recent weakness in the telco in the first half presents an opportunity for long-term investors as solid fundamentals are now being complemented by meaningful value unlocking catalysts. And then last sector for me would be the mining sector. So we continue to expect volatility for the mining sector in the near to medium term, but we see long-term outlook to remain attractive. This year we have seen two different stories in two different metals. Gold prices pulled back as investors adjusted to higher interest rates, stronger dollar, and global macroeconomic headwinds, while copper remained supported by global deficit and long-term demand from EV, renewable energy, and data centers. So, although commodity prices may fluctuate in the short term, the structural demand story remains intact. At the same time, on a micro level, the Philippines is one of the richest minerals or mineral resources in the world, but much of it remains untapped. And as shown in Figure 2 on the lower right side, the country holds significant gold reserves. Yet only small portion of it is of its mineralized land has been developed, and that creates long runway for growth as new mining projects move forward. And in the past few months or past few years, we have seen renewed investor interest in the local mining sector amid elevated metal prices, which has actually fast-tracked the development of several large-scale projects. So this include Apex Amacan Copper Gold Project and also Felix Mining's Silangan Copper Gold Project. And beyond these flagship developments, we believe the country remains one of the world's most mineral rich yet underdeveloped mining jurisdictions. And also, we believe that this underpenetration, coupled with improving project economics, with metal prices still elevated, and also there's a growing consolidation opportunities. Um, we believe that well-capitalized miners are well positioned to pursue both organic and inorganic expansion through mergers and acquisition to replenish their reserves, extend mine life, and also expand production capacity. Under our coverage, we have buy rating on Apex and OGP as both miners are well positioned to capitalize on the mining sector's next growth phase. We project Apex to maintain a conservative DE ratio, while we expect OGP to remain in a net position or in a net cash position, providing ample capacity to fund expansion prospects and withstand commodity price volatility. So, for the next sector, for the consumer sector, I'll pass on the floor to our consumer and gaming analyst, Jerry Alfonso.
Thank you, Peter. Thanks, Peter, for discussing the most talked about sectors right now, the hot sectors. So now let me discuss the consumer sector. So based on the BSP's latest consumer expectation survey, the Consumer Confidence Index, or the CI, fell sharply to negative 42% in the second quarter, Here in the figure one, you can see the sharp plunge, and that is actually the weakest reading since the pandemic. So household sentiment really weakened as families felt the pressure of higher fuel and food prices. And I'm sure a lot of us were surprised or shocked when we saw our Meralco bills. Probably it more than doubled to a lot of us. We saw it more than doubled. So besides the rising prices, consumers also expressed their concerns over graft and corruption and the lack of sufficient government measures to ease the rising cost of living. So all in all, that influenced the deterioration of consumer sentiment in the second quarter of this year. So now let's touch on the unemployment rate. So the recent 85 pesos daily minimum wage increase in Metro Manila adds another layer to the whole economic picture because the higher wages could actually translate into stronger purchasing power, although the less discussed implication is the pressure that it places on employers. So right now, businesses are already contending with elevated electricity costs, higher raw material prices, and rising OPEX, and the wage hike represents yet another cost that they need to absorb. So moving forward, we do think that companies may choose to slow hiring and postpone their expansion plans. And we think that the wage hike could make it more difficult for the unemployment rate to decline over the coming quarters. So for our third bullet, seen on the screen, we did see gas prices stabilizing during the second quarter, which should have been or which should provided some relief to households and supported consumer spending. However, much of that benefit appears to have been offset by the higher electricity costs because for many households, the savings that they enjoyed with the decline in gas prices were just redirected toward the higher electric bills. So right now we're starting to see fuel prices move higher again, and if this trend continues, consumers could end up facing pressure from both rising fuel and electricity costs. So that means less disposable income for households and more especially for the discretionary spending. So looking ahead into the second half, we do think that food inflation will likely to trend higher due to the elevated fuel prices, the persistently high fertilizer costs, and the weather-related supply risks. So fertilizer prices, in particular, is a headwind for the agricultural sector because the urea prices are still trading above the $600 per ton. And historically, urea prices averages between the range of 250 to $350 per ton. So this is a significant it will greatly impact the agricultural sector because 40% of the total farming expenses of rice and corn farmers are actually fertilizers. And unfortunately, we do not expect much relief in the near term because there's a shortage in India right now and there's a lower production in China. And on top of this, we expect El Nino conditions to reduce the crop yields, which further tightens the supply of agricultural commodities. And to make things worse, the weak peso is another overhang as it raises the cost of imported agricultural products, such as wheat. So that creates another layer or another pressure on food inflation. So overall, we continue to favor the defensive names, particularly retailers of essential goods, as the BSP's latest consumer expectation survey still suggests that outlook is still upbeat for basic necessities. So in this space, we like Pure Gold and CNPF because of their defensive business models. And for CNPF in particular, we like that the company um actually, their earnings got released earlier today. They posted a healthy double-digit growth in their top line, and currently they're having a briefing right now. So they're probably giving guidance to analysts already for their outlook in the second half or for the balance of the year. So we also like the tuna spot prices is also correcting because from the peak uh of 2,000 dollar per metric ton, it already went down by $1,700 per metric ton, which should help the margins of their OEM segment. And we also like the company's ROE. Valuation-wise, it's still trading at a 32% bargain compared to its historical average. And this is despite the fact that the company has a superior ROE among the consumer sector. So now for the gaming sector on the next slide. Globally, there's a slowdown in gaming activity, and most likely this is really due to the Pogo crackdown led by the Chinese government. Because even Las Vegas, there's a slump in visitors. And there's an article that I read recently that and it says that 75 to 90% of Las Vegas high rollers were actually Asians and majority were Chinese. So when the Chinese government started the Pogo crackdown, the game activity really weakened. So if we are to recall the 1Q numbers of gaming operators here in the Philippines, in the first quarter, we saw Bloom, Okada, and Travelers all logging a drop in revenues. And Pagcor chief Tenko already warned that the full year 2026 GGR could plunge by as much as 19%. So they already downgraded their expectations to 320 billion to 350 billion, which is down from last year's performance of 396 billion. So their forecast or their downgrade was really due to number one, the price shocks are already squeezing the budget of players. So players are now prioritizing essentials over entertainment spending right now. And second, the e-gaming operators in particular are already having a hard time onboarding players that was gone due to the delinking measure last year. So that's it for the gaming sector. I'll now pass the floor to Lance for the construction. Thank you.
All right. Thanks, Jerry. So for the construction sector, we saw construction costs in June increase by 2.9% year on year in Metro Manila. This was mainly driven by structural steel and reinforced steel. So for structural steel, it went up from 1.6% to 3.7% in May. And we believe that these costs are actually higher than what PSA data suggests, with EEI noting that average costs for them increased by 12% in May. And I was able to talk to a private contractor in operating outside Metro Manila who stated that costs actually increased by 6 to 8%. So this obviously pressures the already thin margins that construction companies have. And we believe construction costs to stay elevated as these higher oil prices lift these even further. So as a net oil importer, we will see these oil prices feed in continually through a broader inflation, and we project a 50 basis point rate hike for this year. So what happens now is tighter monetary policies that would lead to tempered construction demand from borrowing costs that would ultimately lead to extended investment timelines as contractors push these even further. On the other hand, for May, approved building permits were down 11.6% year on year, which is the sharpest contraction within 8 months. So this was mainly driven by residential permits that make up 2/3 of the total building permits. Residential permits were down 16% year on year, and also accompanied by commercial permits, which were down 12% year on year. Contrarily, we saw non-residential permits go up 7% year on year, which was supported by ongoing investment in manufacturing, logistics, and infrastructure. And we expect this trend to persist and feed into the rest of the year and as we step into 2027. So for infrastructure spending, it remains a key factor in the construction sector because it offers a longer revenue visibility for the construction companies. And capital outlays fell 45.6% year on year in the first half of 2026, as we still feel the effects of the flood control scandal. But a potential tailwind that we see here is that the government is actually planning to accelerate infrastructure spending at the second half to help catch up to our GDP target or the government's GDP target. And for the only covered construction stock of USI, for MWide, it is currently focusing on their 4PH program. So we see the boost in infrastructure spending to be of little benefit for MWide as it focuses most of its construction capacity on its government housing program. And that's it for the construction sector. Now we move on to the logistics sector. And despite conflicts in the Middle East, global goods trade up 12.5% year on year, with the UNCTAD noting that this was partially due to higher prices instead of trade volume, the increase in trade volume. So for pure comparison, South Africa saw a 75% increase in fuel costs, with ICT's peer DP World passing this on to customers through higher charges. And we see this trend go for most port operators. In fact, if we look at figure number one, the Drewry World Container Index, so this index is a gauge for 40-foot containers and their prices. So the freight rates for these containers went up 74% year on year. Port calls, on the other hand, were broadly flat in total, from 843,000 in January to the same number in June. And companies shrugged off costs, but we believe that another round of oil price hikes will eventually pressure demand as countries dig in deeper into their strategic petroleum reserves and these crack spreads widening. Next up, port calls surged in March as these importers and exporters rushed to fill inventories. East Asia, we saw East Asia drive overall growth, driven mainly by China and South Korea, as these countries were heavily exposed to the AI hardware and semiconductor trade. So we also saw Africa and Americas doing more import growth. Africa saw greater volume as ships changed routes away from the Middle East and the Red Sea and down around South Africa. This increased shipping times by around 2 weeks, but ensured safe passage. Globally, semiconductors, machinery, EVs, batteries, and minerals saw an improvement in trade, while renewable energy products softened as well as chemicals, iron, and steel. So as stated earlier, for East Asia, we saw big volume growth, but ICT does not have any significant exposure to this anymore. So their strategy of constantly being aggressive in entering and growing ports in emerging markets, as well as being immensely diversified, have always shielded them from market downturns. We see this in their investments in Durban and Batu Ampar in Indonesia, which pumped up volume 16%. But without these two, volume would have only increased by 1%. Furthermore, a number of developing countries were included in the latest round of US tariffs, which is unfortunate for ICT, given that most of its terminals are located in emerging markets. In fact, only 5 of the countries where ICT operates were spared from the new measures. It's also worth noting that the original 2025 Liberation Day tariffs were much broader in scope, with nearly every country facing some form of tariff. So that environment actually benefited several of ICT's emerging market ports as global trade flows shifted away from countries facing steeper duties. So, for example, Ecuador's Contecon Guayaquil, or CGSA port terminal, recorded a sharp increase in activity, helping lift consolidated volume in the Americas for ICT by 19%, as the country's economy rebounded from a 2% GDP contraction the previous year. In contrast, terminals in developed markets such as Australia experienced softer volumes, while ports that primarily serve domestic trade were largely insulated from the disruption. As for our logistics sector coverage for ICT, we believe that it is already trading fairly at current levels, with our target price at 1,091. So its PE of 20.4 is actually in a bit ahead of most peers, with emerging Asia's 2026 PE trading slightly higher. So that's it for our logistics sector. Now move on.
All right. Thanks for that, Lance, Jerry, and Peter. So I think that's it for our mid-year outlook. If you have any questions, we'll now open the floor for Q&A.